We think women need to talk more openly about money because money really matters. It shouldn't be embarrassing or confusing. Join the conversation. We'll be discussing a whole range of topics which will help you get comfortable with your finances. Money Matters. Brought to you by AJ Bell. Hello and welcome to this episode of the AJ Bell Money Matters podcast. I'm Danni, and if you're a regular listener, and why wouldn't you be, then this episode is going to feel a bit different. It is our tax year end special. It's going to be full of tips and tricks to make the most of your allowances. Really useful if you are already investing. And for our newbies, we're going to take you through what those allowances are, breaking down all the jargon and keeping things really simple. You might have noticed Laura isn't with us this week. She is taking a well-earned break, but I've drafted in a couple of other members of our Money Matters team. If you read the articles on our website or you've listened to our other podcasts, you will know their names. Rachel Vahey and Charlene Young. Welcome, ladies.
Hi, Danni.
Hi, Danni.
So I'm going to play interviewer for this episode, and I'm going to push you guys to do all the explaining, which is really nice because I feel like I'm having a bit of a break. So I'm going to start with the absolute basics, and this one comes your way, Charlene, because some people will be wondering what on earth we're talking about. What is tax year end? And why does it happen on a seemingly random day in April, not at the start of either the new calendar year or even on the 1st of April?
Yes. Well, tax year end, I guess if I was going to describe it, I'd call it like a financial anniversary, financial birthday. So as you've mentioned, every year on the 5th of April, one tax year ends and the next day, the 6th, another one begins. And for our personal finances, it's really important because that's when various allowances or tax allowances, as you've mentioned, restart. And we'll kind of go into what they are a bit later, I expect. You'll be quizzing me on that. So, yeah, as you mentioned, the UK, a bit of an outlier when it comes to the dates. So lots of countries have a tax year end that actually runs in line with the calendar year. So your 1st of January to the 31st of December. Most notably, I think the USA and also some of the countries using the European single currency. Now, our tax year end in April has been that way for actually hundreds of years. It used to run with a different type of calendar to that calendar year end, and then it basically just been transferred across, and it just so happens that it falls on the 6th of April. It is a bit weird, not gonna lie, but lots of systems and tax calculations and everything are built around it. So, every few years there seems to be a debate on changing it. That would be massive, and actually no one can really agree on what date we should use. And do we really want to have sort of ISA season and the festive season at the same time? I know I probably get more excited about ISA season than the normal person on the street. Yeah, it feels like quite a lot, and I think some of our accountants probably would have a few things to say about mixing those two as well.
Yes, I can imagine. I got caught out because I was writing an article for an Irish newspaper recently based in Dublin, and I was talking about tax year end. They were like, no, ours is the start of the year. And like, that actually makes sense. But then I figure when we have to deal with self-assessment deadline of the 31st of January, we don't want anything else in January, let's be honest. Tax, we've spoken about there. Clearly, tax year end, it is a factor. So what if you're an employee?
Yeah, so as we mentioned, that new financial year, that anniversary brings with it new allowances. And when we talk about tax allowances, we actually cover quite a few different things. So kind of really importantly for us, earning how much you can earn a year tax-free, but also how much you can pay into accounts like ISAs, so individual savings accounts, how much interest you can earn from your non-ISA cash each year, and actually the amount you can get as dividends before income tax starts to become due. So many of these allowances have actually also been frozen since 2021 now, and they are going to continue to be frozen until at least 2028. Some of those investment ones that I mentioned have actually even been slashed in the last few years. So whilst employees might not have seen tax rate rises on their incomes, frozen allowances are sometimes called a stealth tax because they lead to people paying more tax over time. So if you think as your salary or your wages are hopefully going up, if the amount you can earn before tax is still frozen, actually it ends up capturing more of your increased earnings over time, and meaning that you're going to end up paying a bit more tax. Your income and your earnings for a tax year and that of your partner also affects your entitlement to certain childcare support, for instance.
So things like child benefit and tax-free childcare. And I know that you've been talking a lot about something which has become quite a trend on TikTok, which is this 100,000 cliff edge, which really impacts your ability to, claim that tax-free childcare.
Yeah, absolutely. I mean, I never thought I'd become, it's not me personally, I'm sounding like a bit of a narcissist now, but talking about tax would become trendy on TikTok. It's like one of my dreams, I think. But yeah, the UK tax system is complicated. I won't go into all of it just now, but there is this particular cliff edge and distortion where someone with income that tips over £100,000 actually starts to be worse off for a while. So when you take into account things like a personal allowance that is lost, so that amount you can earn tax free each year, that starts to be lost if your income reaches that £100,000 level. Also, your entitlement to different types of childcare support, notably tax-free childcare, like you've mentioned. So once you add in the impact of those lost support allowances and the lost tax-free personal allowance, there's this horrible gap where somebody actually would need to earn nearly sort of £40,000 more after £100,000 to actually take home the same amount once you add back in the value of those. So yeah, it's something I've sort of done a bit of work on in the press as well, and it's just bizarre. And we're all here, you think earning £100,000, oh, that sounds like something, I don't feel very sorry for people like that, but we've got that system where it's actually putting people off working more, putting people off investing in the UK. It kind of goes against everything we've seen the Chancellor try and reverse in recent months.
Let's bring Rachel in here now. Rachel, I know pensions obviously are going to be an internet sensation.
They always are, yes, absolutely. I think it's one of those subjects people are probably more interested in than we give them credit for. You always think pensions is quite a dull subject, but if I tell people I work in pensions, then I've usually got a queue of people asking me very random questions. So yeah, big interest.
I know whenever we go to a Money Matters event and we say Rachel's here to talk pensions, I find that you are swamped by people coming to you afterwards and asking, very personal, often very obtuse and unusual questions. But is there anything about tax year end that's relevant when we're talking about pensions?
There's something that's very relevant to what Charlene's just been speaking about, and the fact that you might be near a threshold where you start paying more tax. And Charlene's covered the £100,000 threshold, which is really important. And, as she said, is gaining a lot of interest. But it could be some people who are around just going from paying basic rate tax to paying higher rate tax, and they're just very close to that threshold. Well, pensions are absolutely brilliant when it comes to tax advantages, and I know that both Charlene and I can rabbit on for ages about how good they really are. But one of the magic tricks that they have is that you don't pay any income tax on your pension contributions. So if you make a pension contribution, then what it can do is to reduce your taxable income. And that way, if you are just slightly over one of these thresholds, just slightly over going into just over 100,000, or if you're slightly over the £50,270, which means you're going to pay higher rate tax. If you pay a pension contribution, you can just bring your salary just under that threshold. And it just means that you pay less tax in the long run. So it can be really, really helpful. And another way that if you sat there thinking, well, I'm not really going to get up to 100,000, Rachel, but thanks for the thought. But if you really want to think about another way it could work, is child benefit. We know that if you earn or the person in the household who earns the most is earning between £60,000 to £80,000, then the child benefit slowly gets taken off them. So again, if you're close to those thresholds and you want to grab back a little bit more of your child benefit, or you want to not face as big a tax charge on your child benefit, then what you can do is pay a pension contribution and bring your taxable income just slightly under. And again, you might get some or all of your child benefit back. So pensions can really do some proper magic around there.
I love that, talking about pensions being magic. For people that haven't got a clue, really, they just get used to hopefully, their pension coming out of their wages every month, or maybe they've set up their own pension. But just remind everyone how much they can pay in every year.
Yeah, well, this is actually a lot more complicated than it should be in practice. I should be able to give you a figure and then that would be it. But it's actually quite complicated. So I'm going to keep this quite simple. Most people will be under the allowances. That's probably the first thing to say, well under their allowances. But sometimes you get an extra payment. Maybe you've got an inheritance or you been made redundant or something like that. So knowing how much you can pay into your pension, I think, is always helpful, even though most of the time you don't really need to know about it. So there are probably two main things to know. The first one is that you can pay in your personal contributions as much as you can earn. Okay, so that's hard stop. You can only pay in as much as you earn. So if you earn 20,000, you can only pay in £20,000. The second thing is that all the contributions going into your pension. So this includes ones that you've put in or ones that your employer has put in, or maybe even ones that your partner has put in for you. All of those together, those can't be more than £60,000. And this is called the annual allowance. Now, there are some exceptions to this rule, because that's the great thing about having rules, isn't it? There's always exceptions. And the first one is that you can put in maybe more than £60,000 if you look back and think, I haven't used up that £60,000 allowance in previous tax years, in the few tax years in the run-up. So I'm going to put in a little bit more. But remember, you've still got this one overriding that says you can only put in as much as you personally earn. The other thing you might have is that allowance, that £60,000 allowance, might be less than 60,000. And that's because you are a really high earner. You have to be earning quite a lot of money for that to count. Or because you've already accessed your defined contribution pension. So a pension which is like a SIP or a personal pension or a stakeholder plan. If you've already taken some money out of that, then it's likely that your annual allowance is going to be reduced, and it will be reduced right back to £10,000. So it is really complicated, but it's probably just worth having this first one as your personal contributions as much as you earn, and your second one, the annual allowance, and just keep having those in the back of your mind. If you are in the position, you can just put in a little bit extra into your pension.
They don't like to make it easy, do they? I tell you.
No.
Laura and I on last week's pod spoke about all the bill increases that are happening in what has been dubbed Awful April. And Laura, of course, was sharing that she called her daughter April and now sometimes regrets it because she has to use that phrase quite a lot. And so we spoke about changes to the state pension, changes to benefits. So if you didn't catch that one, do listen back. We also spoke about national insurance contributions, both on the last pod, and we've spoken about it before as well. I'm just going to mention that things are changing from tax year end, because after the 5th of April, you'll only be able to plug holes in your contributions going back 6 years. So again, if you've been putting off taking action, if you've heard us speak about this before and we've said, look, now is the time, you have until the 5th to fill in a callback request with DWP. But you just must make sure that you do take a photograph to prove that you have filled in that callback request. And of course, as with everything that we talk about on here, do remember everyone's situation is different. So just check that it is the right decision for you to plug those gaps. And you can still plug 6 years worth of gaps even after the 6th of April. But let's move on from pensions to other investments, because I think that 11:59 p.m. on the 5th of April is a really important date and time, Charlene, very specific for investments.
Yeah. So we've sort of mentioned tax allowances and what you can pay in. So it's probably worth, after hearing Rachel talk about pension allowances, talking about other types of accounts. So 1159, those allowances, that will be your last minute to use them before everything gets reset and reset for another year. So ISAs, individual savings accounts, those tax-free accounts that we love and we talk about a lot, actually. We will have a quite generous allowance of £20,000 a year to use across all of those different types of ISAs. So most notably, your investments, so your stocks and shares ISA, your cash flavour. That also includes the lifetime ISA for anyone who has got one of those. So that £20,000 covers all of those accounts. There's also the junior version of ISA accounts for under 18s, and they come with a generous allowance as well of £9,000. And like I said, anything you don't use before midnight is lost. So unlike those pension allowances where you might be able to carry over something that you haven't used if you've come into a bit of money and want to stash it in your pension, ISA allowance is a little bit more simple. You have that fixed amount, you use it or you lose it. As I mentioned, yes, for people who are able to use them up, you'll get a brand new set on the 6th of April. And I think if you can, using these allowances early in the tax year often means you're getting in there early with the benefits of things like compound returns, compound interest, if you're able to.
We speak about compound interest a lot. It's one of Laura's favourite topics to talk about. Look, when we're thinking about money that people have made from their investments over the past year, maybe they did get in early, what can they be thinking about here to protect their investment growth from the taxman?
Yeah, so as I mentioned, I love ISAs. I love pensions too, obviously. It's in my job title. But why do we love them so much? Because along with sometimes tax bonuses on what you pay in, they're a tax-free shelter for the investments and the cash that you've got inside them. I know I'm not supposed to be using jargon terms, but I will, forgive me. I will sometimes refer to them as wrappers because I think that's quite a nice, magic ISA wrapper. It wraps that cash and investment away from tax. But that's my past and I've used it now. So anything else, Danny's going to get very cross with me. So back to investments, I digress. So if you're selling some investments that haven't been held in one of those kind of magic ISA wrappers, you do need to keep an eye on something called capital gains tax. So for capital gains tax, that's looking at money you've made when you sell an investment, your profits, if you like. They're just referred to as gains in investment land. So everybody gets a tax-free allowance for gains as well that aren't in an ISA each year. That's £3,000 for this tax year, and it will be £3,000 for the next tax year. Anything that you've made or any profits or gains above that £3,000 will be subject to capital gains tax. The exact rate depends on your income, actually. But the important thing, again, is you can't carry this allowance over into a new year.
So let's talk about the new tax year then, because allowances are reset, people are coming in fresh. Let's start with investments and then I'll come and talk again a bit about pensions just to sort of catch up on where we are.
Yeah. So as I mentioned, if you've got investments outside of these tax-free accounts and you want to keep the actual investment, you like that company share, for example, you like the prospects, but you're interested in kind of sheltering it from tax because you're hopefully going to make some money on it. You can get them wrapped up within an ISA using something known as a bed and ISA. It's a weird name. It's a really weird name. I think it goes back to some historic tax rule again, but it's called a bed and ISA. You will see that around whoever you use as your investment provider. So what does it mean? It's where your provider, you can tell them to sell an investment and then they can immediately buy it back in an ISA. So at AJ Bell, for instance, that means one dealing charge for shares rather than one for selling the share and one for buying it back in the ISA. And you're actually out of the market for less time because you're not waiting for the sale to complete and then you're not moving the money yourself. Your provider will do that for you if you tell them that's what you want to do, a bed and ISA deal. Things to watch out for, as well as capital gains tax. If you are making profits when you sell that investment, keep an eye on that. You might face some other costs like stamp duty on UK shares, and there will still be a small difference between the buying and selling prices you get for that share, even if the actual kind of transaction, if you like, goes through pretty quickly. And one thing to remember is, although you're not manually moving that cash from that account into your ISA, the value that is going into your ISA still counts towards your £20,000 a year allowance. So whilst many people kind of think of it as a tax year end thing, we looked at what our customers are up to. Danny, I know you are a big fan of this as well. Having a look.
I like peeking behind the scenes, yeah.
Such nosy people. Most of our customers actually do this in the first few weeks of the new tax year. So we're really seeing people kind of get ahead and make the most of those allowances when they renew. So I thought that was pretty interesting. Now, also with investments, if you're married or you're in a civil partnership, you also can transfer investments and cash as well between yourselves. So, and that doesn't trigger capital gains tax for investments. It doesn't trigger any kind of gifting or other tax rules. But you do have to be married or in a civil partnership to make the most of that. And why is that a useful trick? Well, you might be earning a different level to your partner. If you're earning more than them, if you transferred investments to them and they came to sell them and make a profit, they might actually pay capital gains tax at a lower rate. Again, you can share allowances. So your savings allowance, your personal savings allowance, the amount of interest you can earn outside of an ISA before any income tax comes into play. You each get one of those. So, if you're comfortable transferring capital investments and sharing that with your other half, with your spouse or your civil partner, I should say, that's a way of really maximizing those tax-free allowances on offer. And as we said, they've been frozen or slashed. So, if we're on the lookout to kind of save as much tax as we want, let's be honest. So, some accounts also offer free cash or a bonus. I think Rachel might touch on that when it comes to pensions and something called tax relief. But there's also accounts like the Lifetime ISA that give you a bonus on what you pay in. So that would give you £1 for every £4 you pay in. It does come with some pretty hefty strings attached, though, some hefty penalties if you don't use it for its original purpose. And that is to either buy your first home in the UK or for retirement in later life, so once you reach age 60. And of course, you need to be between age 18 and 39 to take one out in the first place. But again, if you're looking to make the most of that account to either get on the property ladder or have a nice tax-free pot extra at retirement, it's worth knowing about that one.
And it's really important to stress, because we've been talking about, some big numbers in some cases. But when we're talking about these allowances, you don't need to use them all up in one go, although lots of people might choose to do so, because actually starting really small can be beautiful.
Yeah, absolutely. And like you say, with all these kind of figures flying around, it can be a bit daunting. We're talking about 20,000 here, 9,000 there. The allowances are generous. But, less than 10% of ISA holders actually used their full ISA allowance in the most recent year that we get the data for. And actually almost, I think it was nearly 2/3 of people, just over 60% of people paid in less than £5,000. So yes, the allowances are there, they are generous, but that doesn't mean, don't beat yourself up if you're nowhere near being able to use them. Getting started is, like you say, often kind of the biggest barrier in itself, particularly when it comes to investments. But I like to think it needn't be, because you can really get started, AJBL from as little as £25 a month. So if you get in the habit, and we know lots of women are really good at this, putting money aside, paying yourself first, we like to call it, when your salary arrives or however you get paid, I think you'll miss the cash less, because you're not sort of waiting till the end and then putting that last bit in. And as well as paying in kind of regular cash to your account, let's use an ISA for an example. Make sure you also set up automatic, or what's called regular investing, for the investments you actually want to buy. So there's kind of two sort of automatic things that you can do there, two hacks, if you want to call it that. And why is that good too? Well, providers usually offer a discount on dealing charges when it comes to investments if you've set up that automated trade. And also, most of all for you, it takes out the guesswork of investing, as it happens on or around the same day each month. It's just basically like a direct debit, but into an investment. So, investment prices do go down and up. So you'll end up kind of smoothing out those ups and downs, those peaks and troughs when it comes to buying in. And there's a reason in investment boards we like to talk about time in the market rather than timing the market. So that's where that kind of regular investing really comes into its own.
I love that old chestnut. Rachel, there are some hacks as well when we're talking about pensions, and tax year end's a really good time, if you've not done it already, basically to spring clean.
Absolutely. And I think it's a lot of what Charlene's just been explaining applies to pensions as well as it does to any other type of investment or ISA or whatever. It's getting into the habit, isn't it? It's just forming the habit of paying into something regularly. And I know that if I take it out of my thought process and if I set up a direct debit, then it's a lot easier. That way I don't miss my energy bills or my council bills or paying off my credit card or whatever it happens to be. It's just taking the stress out of it, isn't it? If you can just make it a regular payment that you don't look at. But on the other hand, having a look at things is really, really good for us. So it may be that you want to use this spring clean feeling of a new brand April to have a look at how much you're paying into your workplace pension and to just look at the start of the tax year. Now, often what happens with workplace pensions is that they are you pay in on a scale. So you might start off at the basic amount, but your company might say, and your employer might have terms where it says, well, if you pay in, say we increase your contribution from 5% to 7%, I'll also increase the contribution I'm paying in for you as well. So a little bit of money, extra money from you might mean that you get double the amount going into your pension. So it's definitely worth investigating and at least knowing what terms are on the table. So I think you just have to go out there, have a look at your intranet, your company intranet, or go and speak to your HR department or your people department, or go and speak to your employer and find out what deal is on the table. And if it's not obvious, be big and brave and go and ask them directly and find out exactly what's happening. Because once you know that, then you're in the position to decide if you can afford to increase it and to find out how much more money that means will go into your pension if they also increase their contribution. Now, if they're not going to match it, so if they're not going to increase it, that your employer, then you may think, well, I'll still put in a little bit more money for myself. And you might want to do this around the time that you get a pay increase, because if the money has been taken off your salary before it really hits your bank account, then if you could do it at the same time you get a pay increase, you may not notice the pain as much. You may not lose out on that, feel like you're losing out on money. And it automatically just goes somewhere to start saving for your later years. So to do it around about the same time as a pay increase is a really good thing to think about. So if you do decide to set up a pension, have a look and read up, see how much the charges are, see where you can invest, and go and see what feels right for you. A lot of these pensions some of them offer some really good deals, but sometimes it just boils down to what you feel comfortable with and the communication and how you think, how everything is set out. So go have a look, have a think about what you want to do. If you're not in a workplace pension, then one other thing you might want to do is just double check with your employer. Now, most of us are automatically enrolled into a pension when we start work. And if you earn over £10,000 and you are over the age of 22 and you live in the UK, then you should really be automatically enrolled into a pension. And then you can choose whether you want to stay in the pension or you can opt out if you want to. So if you've opted out previously, then you have to be opted back in again every 3 years. But if you've done that, say, a year ago, say you opted out a year ago, you may want to get in touch with your employer and ask if you can go back into the pension scheme. And they may be happy for that to happen. Alternatively, if you say you don't earn £10,000 with that employer, you might still want to get in touch with that employer. And it may be that if you ask to be put into the pension scheme, they will have to pay a pension contribution for you. It depends upon how much you earn and some terms and conditions. But generally, it's definitely worth a conversation. So again, go and speak to your employer and find out what the deal is, because your employer contribution to your pension, if you don't use it, it doesn't go anywhere else. It doesn't go back onto your salary. It just disappears into the ether. So it's lost money. So it's really worth trying to make sure that you get as much bang as you can for that buck, and you get it put in your pension and it's working for you. So that covers your workplace pension and maybe setting up a new pension for you. Something else you might want to do is to see what's happened to all those old pension schemes that you once had. Because if you've moved employer, then that pension scheme that you previously set up with your employer through your workplace might just be sat there, maybe carrying on investing and everything like that, but there's no new money going in. Now, it's easier sometimes to manage all your pensions if they happen to be in all the same place. So it might be worth having a look to see if you can combine all these pension schemes together. You might get lower charges if you do that, or it might be you get better investment options, or it might be that you just prefer the company you're with at the moment, the pension provider you're with at the moment, and you might think, well, actually, I just prefer that communication and that setup and the service I get. So that might be all really good reasons why you want to just combine all your pensions in one place. So you just need to really go out and find that. And that's a lot of the time just rooting through our, well, I use the word paperwork, but I'm feeling very old when I say that, Danny. I used to say go rooting around shoeboxes and find out all your information, but I don't think that happens nowadays. But it's scrolling through emails, isn't it? It's scrolling through all that back administration to find all those details and to get in touch with your previous pension providers and then just transfer them maybe over to your new pension provider. And just a little bit of a personal anecdote. I've just done this. I've just set up a new pension just before tax year end and just transferred an old pension scheme I had into it. And it was so simple, so easy, really straightforward, happened really quickly. The pension provider kept me up to date with what was happening. So I was sort of dreading it a little bit, and I shouldn't have, because it was really simple and really straightforward. So absolutely, go and have a look and see if you can find these old pension schemes. There may be just one last little thing on that. It's always worth watching when you transfer a pension scheme to somewhere else. There may be good reasons for not doing it. You might have certain guarantees there, which means that you can get a better deal on buying something called an annuity. Now, an annuity is just a secure income that lasts you for your lifetime. But the way that you do it is you hand over a pot of money, and then the annuity provider says, I will pay you this amount of money per year. But it could be that you might get a special deal on that price with some pension plans. So just watch out for that. Some have exit penalties as well, so just be careful. And if it's in a defined benefit scheme, which is another jargony phrase, I'm really sorry about that one. It means it's a pension scheme that's related. How much you get out depends on how long you've worked there and what your salary has been. So again, if it's one of those types of pension, then it may be difficult to move, and it may not be the best solution for you to move either. So just be careful around those ones as well.
You see, we let you off jargon if you explain it in simple terms. And I think often with finance, that's the key, isn't it? Because you can't escape the jargon in finance. But if someone can explain it to you simply, Rachel, that light bulb goes on.
Absolutely. And you come across these terms all the time, don't you? And it's just so nice to have a simple explanation for things.
And I have to say, Charlene, that for me, the fact that we don't have a shoebox anymore with all the paperwork, I think it actually makes it a little bit harder, because it used to be that, all right, it might be down the bottom of the pile, but everything was in one shoebox. Now, if you've got a couple of email addresses, it can get lost.
It can, and I always go back to Friends when I think of this and Monica's messy cupboard. I mean, a bit of a niche reference there, but yeah, no, definitely. I have a bit of both. I've got definitely some old paperwork, but there is one thing actually. If you do remember to download your statements. I keep them on sort of a secure storage, or hackers, there you go. But yeah, actually, if you move providers, for instance, like a credit card provider, and I needed to go back and check something, once I'd completely left and closed that account down, I had to contact the bank to order my statement as paper. So yeah, I mean, a bit of nostalgia. It's sort of like keep track of things, but maybe try and make sure you download them. But I like having the stuff we get in that secure place, and then I can refer back to it when it comes to sort of tax return season. That's a whole different season, not for today.
It's a virtual shoebox. Yeah. We could start that. I can see that becoming a thing. While we're talking paperwork, let's also talk about paper money, because cash is the elephant in the room. I don't know if all of you listening have seen our gender ISA gap report. If you haven't, do take a look, because keeping your savings and investments in cash can impact your financial health in the long term, Charlene. And, we're hearing a lot about interest rates and inflation again.
Yeah, back in the news for sure. And, cash in the news too. So I think when we're thinking about ISAs, and that, obviously is the topic of that fantastic report, I want to start with some good news, because there's around 1 million more women with a cash ISA than men. However, if you flip that over, nearly 500,000 more men have the investment version, so what's called a stocks and shares ISA, than women. So the good news there is, obviously, as I've mentioned before, once we sit down and think about it, we've planned out. We like to plan things. We like to know everything what's going on before we make a decision, like an informed decision. Women are clearly really good at that, budgeting and saving. But that cash versus investment split, that really matters, because men actually end up having on average £3,000 more in their ISA, I believe, than women. And when you extrapolate that out, that leads to the overall gender ISA gap of £6.6 billion. That is a really scary number. And why do we talk about investing? Why do we care about it? I work for an investment provider. Of course, I'm going to talk about the virtues of investing, but that's because over the long run, the stock market will outperform cash. I feel like I'm going to get the compliance department on me for this one, but cash feels safer, but it gets eaten into by inflation. Now, I, not that long ago, would have had inflation as a bit of a jargon term, if I'm honest, but it's something we've all become uncomfortably familiar with over the cost of living crisis. Inflation is the rate at which prices increase. We saw record inflation not that long ago. Yes, it might have started to slow down, but that is building on that already heightened kind of plateau, if you like. So it's smaller increases, but on a larger base. And, getting started with investing can be daunting. Rachel's mentioned pension schemes and being auto-enrolled, automatically put into a pension. And actually, if you don't choose an investment, that investment is also automatically chosen for you. So I think the first thing is most people are invested. Some people might not just realize that just yet, and that's fine. But if you're looking at an ISA, perhaps you've got some money in a cash account or a cash ISA, and you're thinking, I really should get involved with investing, but I really don't know where to start at all. Lots of different providers have sort of ready-made solutions. They might have funds that I think of funds as just like a little shopping basket of different investments. You can get lots and lots of different types, but you can also get ones that spread investments across different areas, different types of investments. So shares in different countries, for example. So have a look what's out there. Lots of people have sort of made these solutions to help people kind of get on that first step of the ladder. We don't always want to just go and put all of our money into the thing we think is going to make the most money the most quickly. That's not realistic, and it's not a long-term strategy, but there is help out there. And I think something we're all really kind of passionate about is that kind of education to help people get that confidence to take that first step. And once you've done it, you can get started, as we've talked about, automated, regular investing. Once you've taken that first step, you're away. If you know you're in it for the long term and you've got those kind of tips set up, let's all hope that more people can enjoy the long-term benefits or prospects of investing.
Now, before we leave you, let's talk very briefly about some benefits that people might be entitled to that maybe they've missed out on. We have already spoken a little bit about child benefit and tax-free childcare, but in some cases, there have been some changes. People that maybe thought that they couldn't claim child benefit or would have to pay it back might actually be able to get it. So it's worth having a really quick look for those.
Yeah, a quick kind of 60-second rundown. I will try my best. So child benefit, normally for children up to age 16, or it can be up to 20 if they're in approved full-time education or training. Now, for a family of 2 children, that could bring you in an extra over £2,000 a year. So the way it works is you get a slightly higher amount, just over £25 a week for a first child, just under 20 for the next child. Now, as Rachel mentioned, there are some thresholds here over which you start to have to repay that child benefit. So once your total income tips over £60,000, it starts to get clawed back at a rate of 1% for every £200 over that threshold. Now, that is a change on what it was up until the end of last tax year. Those thresholds have gone up. So once you get to £80,000 now, it is lost completely. Now, normally the way it happens is you might receive the child benefit, but actually you end up having to pay it back in a tax charge. Now, you might think that's just a total pain and like I have to claim it and then pay it back. I just won't bother at all. But it really is a good idea to even just register for child benefit. If you know you're going to be way over that £80,000, you can actually just opt not to receive the money in the first place. And so why would you do that? Why bother claiming something and then not the actual money? Well, it unlocks national insurance credits, something we talked about earlier. And if anyone's taking off time off work to care for your children, you'll get a credit for that year, even if you weren't earning enough to perhaps get the credit in the traditional way. It also means your child will automatically get a national insurance number when they turn 16 as well. I'm not sure if you get one of those physical cards though anymore.
You don't get the physical card, no. I have had the brown envelopes through the door and you get the letter, which is in my cupboard. So I still have my virtual shoebox. It's an actual proper shoebox. Yeah, still get the letter. And it was an exciting moment when it came through the door. But no, you don't get the card anymore, I'm afraid.
Oh, but you still get the number. So you won't, that was just something we took for granted and it just happened. That won't happen unless you are sort of registered for this child benefit, even if you don't claim the money. So, more people will be able to claim it, even just a little bit, or get it back, as Rachel mentioned with those pension contributions. But it's really worth just checking. You can go online now, the kind of childcare area of the government website, gov.uk. It's a little easier to navigate than I feel it was in the past. So have a look there. And then just another kind of childcare support part, tax-free childcare. We mentioned it earlier. So it's worth up to £2,000 per child under 12 per year. Once the child's at school, it can still be used for things like Ofsted registered clubs, like after-school clubs, activities, holiday clubs, and actually even nannies if they are registered with Ofsted. But there is that income threshold. And here it's not a clawback. If your income is over £100,000 for a year, it's just lost completely. So that's kind of what we were alluding to with what you might lose if your income tips over that. And finally, just one extra kind of childcare support help, free hours. So in England and Wales, everyone gets 15 hours per week in term time for 3 and 4 year olds. So that works out about 38 weeks of the year, I believe. If you're under that £100,000 income threshold, so both parents need to be under that, there's actually extra hours available in England and Wales for children from 9 months old and up, so the term after they reach the kind of relevant age. I don't have time to cover all the rules now because there are some big changes coming up to that. It's kind of being extended even further, but I think we've got some plans to do kind of more on this as that English scheme expands. Sadly, it's not available in Northern Ireland. In Scotland, everybody gets 30 hours for those children who are 3 and 4 years old, but there's no plans to kind of extend that age downwards. So a bit of a complication with the different devolved governments there, but definitely something we've done in the past on podcasts. I know that, and I think there might be an article, but we definitely will be doing more. I'm committing myself to doing more on that.
One thing we're definitely going to do more about is talking about saving for kids, and also about kids and their relationship with money and how they feel about it and how to talk to your children about it. So hopefully you'll find that in our next episode. Rachel, we've spoken a little bit about a junior ISA. I just wanted to really wrap up by talking about a pension for a child, because I've seen some incredible figures, particularly when we speak about women, of, having to start saving at the age of 3 when you're still playing with your Barbie in order to have the same pension retirement as a man would have. But actually, you can start a pension for your child.
Yes, you can. And again, I think this builds into everything we've been talking about today. This builds into spring cleaning your finances and how you save and what you save for yourself and your family. And it clicks into good habits as well, doesn't it? Starting with a little bit and little and often, and just creating that savings habit where you're an investing habit where you're doing this every single month. So you can start a pension for your child, and it's called a junior SIP usually. And what you can do is pay up to £2,880 every tax year into it. And then the government will add in some tax relief, and they'll add in 20% of that, which is £520. So it brings it up to a big contribution of £3,600 every year. Now, the downside to that is, the good side is the tax relief, and the downside is that your child won't be able to access it until they are much, much older. Now, at the moment, the age for accessing a pension is 55, but that's going up to 57 in a couple of years' time. So I imagine that by the time my children will be up to accessing their pension, it might be a little bit later still. But those are the rules at the moment, that you can't access the pension until they are older. So if they would like to access the money earlier than that, then again, we're thinking about something like a junior ISA. And we were talking about being able to contribute up to £9,000 every tax year into it. And then what happens with a junior ISA, very briefly, is that you get up to the age of 18, and then at the age of 18, the child has a decision to make. They can carry on with the ISA, or they can decide to take the money out, but it falls to them to be responsible for it and to manage it. And usually our experience at AJ Bell is that I think the majority of children get to age 18 and just keep on with the ISA. They keep on saving. They might take some money out, but they keep on saving. So that's really, really positive. And it's again going back to that starting early, making sure that boys and girls are investing for their future, and then trying to involve children in all of those sort of decisions. And just one other way of saving for your child, can just slip this one in as well, Danny, is something called a child trust fund. Now that might have been set up for your child if you have a child born between 2002 and 2011. I have 2 kids, and one of my eldest one qualified for a child trust fund. Now, what happens is this happened automatically, and if you got to choose a provider at the time, but if you didn't, then it was automatically set up for you. Now, you might have lost track of this child trust fund. I have to be very honest here and admit that I did lose track of the child trust fund my eldest child had. But I managed to track it down, again, through going through all paperwork, and tracked it down. And at that point, you can then decide what you want to do with this child trust fund. It may be that your child is now getting to the age of 18 and therefore they can take the money from it. But if they're not up to the age of 18, then you may want to think about if you carry on with a child trust fund, or whether you set up a junior ISA for your child. You can't have both of those options. You can only have a child trust fund or a junior ISA. But you can transfer the child trust fund into a junior ISA, and that is allowed to happen. It's got all the management of these child funds and investment accounts is by something called the registered contact. And the registered contact is just a formal way of saying a parent or a carer. But you've just got to make sure that the right person is dealing with this. And it's sometimes for the Child Trust Fund, it would have been the mother who was set up as the registered contact, but it could have been the father as well. But you've just got to make sure that it's the same registered contact for the Child Trust Fund as it is for the Junior ISA. Now, if you completely lost track of where this Child Trust Fund is, don't worry. There is help at hand. And if you Google Child Trust Fund and the government, then you can easily get onto a website that'll be able to track down this Child Trust Fund for you. And speaking again personally, it's really definitely worth doing. Find out where it is and make sure you've got all your savings for your children in the right place. And again, you can contribute up to £9,000 every tax year for them.
We're going to do a special episode about saving for kids, about junior ISAs, about children's relationships with money, and of course about our relationship with money, because we are the ones that speak to our children about money, and hopefully we can start them on some good habits. So hopefully you can join us next time. Do take a look at our website at ajbellmoneymatters.co.uk. I've put together a series of articles on there at how our financial lives change over the years with tips for every generation. But ladies, thank you both so much for your time.
Thank you, Danni. It's been a pleasure.
Thank you.
And Laura's going to be back with us next time. So don't forget to sign up to our newsletter via the website, ajbellmoneymatters.co.uk, so you don't miss anything. And if you love art of the affordable kind, then Money Matters is going to be at the Affordable Art Fair on Hempstead Heath between the 7th and 11th of May. So do come along, have a chat. We would love to see you. Until next time, though, thanks so much for listening. If you have any questions about investing, pensions, or any suggestions of topics you'd like for us to cover, do get in touch. Thanks so much for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.